Did you know that in IRS Code 469, you can qualify as a real estate professional to use losses from rentals or syndications to offset your W-2 income? Well, if this is news to you, then you're in luck. Because in this video, we're going to explore a strategy that could potentially save you tens, if not hundreds of thousands of dollars on your tax bill each year, qualifying as a real estate professional. If you're new here, I'm Dr. Jeff Anzalone, a periodontist, not a tax professional. Don't take this tax advice. Check with yours before implementing any of this information. Do me a favor and download our free passive income guide with the link below this video. So let's start off by talking about the benefits of actually qualifying as a real estate professional. So when it comes to building wealth, it's not just about how much money you make, because that's what we're so focused on, right? You know, you're a physician, you're a dentist, you're an accountant, you're a high income earner. You're always focused on that income. But it's also how much money you keep after taxes, right? Or maybe we don't even pay taxes. And that's where the benefits of qualifying as a real estate professional actually comes into play. Now, as a real estate professional, in the eyes of the IRS, you can enjoy significant tax advantages. Typically, tax laws limit the amount of losses from real estate that you can use to offset your income. But as a real estate professional, you're allowed to deduct all of your rental real estate losses against any type of income. Now, think about this. This could be a game changer, especially if you're in the high income tax bracket, which more than likely, if you're watching this, you probably are. So let's say you have some rental properties that produce a net loss, primarily due to depreciation. If you don't know what that is, we've done plenty of videos on that. Check out the list. So if you have rental properties that produce a net loss due to depreciation and other expenses, okay, let's say you have that. Ordinarily, you'd be limited on how much of that loss you can actually to deduct. But as a real estate professional, you can actually deduct the full amount of this loss, drastically reducing your taxable income. Also, the income from your real estate activities is considered non-passive for tax purposes. This means you can only use losses from your properties to offset other income, whether that's your salary, business income, or investment income, because this is non-passive, right? Not just passive, but non-passive. So let's start off by answering the question, how do you actually qualify as a real estate professional? Now, as enticing as these tax benefits sound, qualifying as a real estate professional isn't just as simple as just going out and owning some rental properties. The IRS actually sets out specific criteria that you need to meet to begin enjoying these tax advantages, of course. So first, more than 50% of your personal services in all businesses for the tax year must be performed in real property trades or businesses in which you materially participate. I'll get into that in just a minute. So what this means is if you're, let's say, working as a full-time doctor and part-time managing your rental properties, it may be challenging to meet this criteria because most of your work is spent in the clinic outside of real estate treating patients. Second, you must perform at least 750 hours a year of service during the tax year in those real property trade or businesses in which you materially participate. This roughly translates into about 14 hours per week, which might seem pretty manageable. However, keep in mind that these hours, they must be well documented. This includes not just the hours spent dealing with repairs or tenant issues, but also time spent on the phone with contractors, researching new properties, and even going to and from your properties. Remember, always check with your tax professional before utilizing any of this information. And then third, we talked about material participation. So that means regular, continuous, and substantial involvement in the operations of your real estate activities. Now, there are several tests to measure material participation, and one of which, for instance, is actually participating in the activity for more than 500 hours in a year. Now, while these criteria might seem stringent, they're designed to prevent abuse of the tax code. So if you're considering qualifying as a real estate professional, it's very important to understand these requirements and ensure that you meet them before actually filing for it and moving forward. Now, let's get into how you can actually leverage your status as a real estate professional. First, the way that you actually structure your real estate investments can have a significant impact on your tax income. Make sure, again, you check with your personal attorney or a real estate attorney before you implement what we're about to get into. So first, you want to consider creating a separate entity like an LLC for your real estate business. Now, this can provide additional legal protection and potentially offer more tax advantages. Number two, you want to make sure that you keep meticulous records. Now, as we just discussed, you need to prove that you've spent what? At least 750 hours per year, and that what? More than half of your professional time was dedicated to real estate activities. Keeping detailed logs of your time spent on real estate activities is very important to substantiate these claims if the IRS actually questions your status. And number three, you want to make the most out of, remember, we just talked about depreciation. So, as a real estate professional, remember, you can use the depreciation, the wear and tear that the IRS allows you to write off, the depreciation, to create a paper loss, okay, which will reduce your taxable income even while your properties are what? Two things. They're appreciating, which is fantastic, and they're generating cash flow. So you have this asset out there that's going up in value, that's throwing off cash flow, yet you get to write off the wear and tear. Doesn't get any better than that, right? So consider strategies like cost segregation to actually accelerate this depreciation. This is what we talk about, making the most of depreciation. So consider hiring a group. The one that I use, I'll put a link below this video. Consider using them or another group to get a cost segregation study to accelerate your depreciation and increase your upfront deductions. Now, good news, if you are a passive investor in a lot of the real estate syndications like I am, then the general partners or the sponsors in these groups, they actually take care of this for you. They go out, they hire the cost segregation study groups, they come in, they figure all it up. You can give that to your accountant, and voila, you have a bunch. You have massive amounts of bonus depreciation typically, or accelerated depreciation that you can use over the first year, 5 years, 7 years, 10, 15 years, whatever. Also, consider strategic property selection, okay? So investing in properties that require more active involvement can actually help you meet this material participation requirement. So for instance, if you invest in a quote fixer upper that might demand more of your time for renovations, management, and maintenance compared to just a turnkey property. All right, so remember, while the prospect of significant tax savings is exciting, each situation is unique. So what may work for one person might not work for you or somebody else. Remember, make sure that you consult with a very savvy real estate tax professional before any of these decisions, before we make any of these decisions. Now let's talk about, we've gotten into a kind of the weeds. So let's kind of put all this together and throw out a little case study for you, okay, to help illustrate what the power of being a real estate professional can do, okay? So let's talk about Dr. Smith. And Dr. Smith, he's actually a cardiologist making $400,000 a year. As you know, since he makes so much money, he's in a high tax bracket. Now, over time, he's been smart. Hasn't just put money into a 401k. He's also been putting money back, saving, building a real estate portfolio, okay? And now he has this rental property portfolio that actually is spinning off $150,000 a year in annual rental income. However, when accounting for expenses such as mortgage interest, repairs, maintenance, and depreciation, now his rental activities, they actually show a paper loss. Remember from that depreciation that we talked about and all these other things, they shows a paper loss of $50,000. Now, because his adjusted gross income is well over that $150,000 mark, Dr. Smith, as a passive investor, he couldn't deduct any of these passive losses under the passive activity loss rules. Instead, these losses would just carry forward to future tax years, not really giving you any immediate tax relief. So for instance, if you're a passive investor only, all right, and you invest as a limited partner in a syndication, and let's say you invest $200,000 and then you get back, let's say $50,000 of depreciation on your K1. It shows a loss of $50,000 just like him, okay? But you cannot take this loss, because now it's a passive loss, to offset your W-2 or 1099 income because of the passive activity loss rules. You can only use it to offset the distributions, typically the passive income that you're going to get from the syndication, okay? which is still great. I mean, who doesn't want tax deferred income? And then whatever you don't use, it actually rolls forward. You can carry it forward to future tax years. Okay. But for Dr. Smith, actually, the picture has changed dramatically for him once he qualified for a real estate professional. So now he gets the full $50,000 of rental losses that can now be deducted against his physician income. So now, given that he's in a 37% tax bracket, this extra deduction translates to an impressive $18,500 in tax savings for that year alone. So you take the 50 grand, multiply by his tax rate, and that's how we get that. So again, his example, it's just an illustration, but it can show you the significant tax benefits that a real estate professional status can give you. Now, let's kind of shift gears a little bit and talk about some common misconceptions and mistakes. Okay. So, yes, there are substantial tax benefits with rep status, but there's also potential pitfalls and misconceptions that you need to be aware of. One very common misconception is that by simply owning rental properties, that will automatically qualify you as a real estate professional. Okay. This is not correct. Now, as we discussed, the IRS, again, has a specific criteria, remember, to qualify. Okay. You need to meet the time commitments and the material participation commitments. It's not about just ownership alone. It's about the level of your active involvement. Now, another common mistake is poor record keeping. If the IRS questions your status as a real estate professional, you're going to need detailed records to support your claim. So this includes not just financial records, but also time logs showing your involvement in real estate activities. Failure to maintain accurate records could actually result in lost deductions and potential penalties. Now, some people also believe that qualifying as a real estate professional is automatically going to trigger an IRS audit. Okay. This again is not true. Now, while it is true that the IRS actually scrutinizes claims for real estate professional status, the fear of an audit should not deter you to move forward if you meet this criteria. So you just want to make sure that you ensure that your records are accurate and complete. And again, work with a qualified tax advisor to make sure all your claims are valid. Last but not least, it's essential to remember that, again, while all these tax advantages are significant, real estate should also align with your overall financial and personal goals. Now, real estate investing requires a substantial time commitment. And as you know, just like with any investment, can come with risk. So it's important to assess whether it fits into your broader financial plan and lifestyle. And as you can imagine, we talked about this before, it's always important to surround yourself with advisors and professionals with experience in handling real estate and real estate professional status. If you want to work with the group that I personally use for my real estate activities and also for my dental practice, you can do so with the link I'll put below this video. Take care.